Most people, unless they get ahead of this, are going to pay too much taxes on their retirement income. Colin, what do you mean by retirement income? Well, of course, I mean your Social Security. Colin, wait a minute. Scratch the record here. Am I actually being taxed on something that I considered a tax? Hi, friends. This is Colin Richards, president and founder of Lord & Richards. And once again, I'm excited to be with you on this episode of the Lord & Richards Show. And over the last few episodes, we've been talking about some critical areas of planning. Now, a lot of people refer to end-of-life planning as estate planning. But the reality is, estate is what you own. It's what you have now. And the best thing to do is to protect it now so that you don't yield to the barbarians at the gate, whether you're alive or whether you're passing it on to those that you love. And so we've taught you in the previous episodes about how to get certain documents in place that are critical, like your advanced healthcare directive, your powers of attorney, the people who have control over vital decisions at the end of life, your last will and testament, which, by the way, is not supposed to be your first line of defense. That's supposed to be your last line of defense because it goes to probate or death court. And we don't want our assets going there because things get tied up for months. The costs are often prohibitive, and it's contestable and very public. And so planning in advance to get your assets titled properly to protect you from death court, estate, and other types of taxes as well is critical. And then a document called a trust, which many people will need to make life easy on those that you love, to be able to, I call it an I love you document, to leave something behind that organizes things for those that have to organize what you leave behind. And then we followed that up with understanding that while we're healthy, our biggest problem is going to be taxes. Taxes are our number one cost in retirement or even while you're healthy, typically. And it's not going to bring you to bankruptcy either during or at the end of life, but taxes are something we want to surely only pay what we need to pay and not beyond. So putting documents, trusts, other types of planning in place is critical to make sure you avoid paying unnecessary taxes both now and when you pass on. And so I've taught you about the various tax buckets, the buckets that are taxable to you today, like your ordinary income, short-term capital gains. That means investments that you bought and sold within a year. And then tax-deferred, long-term type buckets for taxes that really stretch out into the future, like your IRA and 401k. You have a loan that you've taken from the government to be able to hold on to that money as long as possible, but eventually you've got to pay the tax man. And then another bucket, long-term capital gains. This is a kind of a preferred tax bucket. Sometimes people get hung up, I can't sell that stock, or I can't make changes in my portfolio. You never see the great investors letting tax decisions outweigh greater investment decisions. Now, of course, we don't want catastrophic taxes, but capital gains is considered a preferred rate that we pay. It's currently capped at 20%. And it's often what is criticized about the rich, frankly, when tax laws are being enacted and the long-term capital gains rate is kept. Often you'll hear that continued war cry, taxes, tax write-offs for the rich, right? Loopholes for the rich. Well, what it is, it's a program designed to encourage investment in our country and in our businesses. And so long-term capital gains means that you pay a reduced rate because you've kept an investment for longer than a year. And when you pass that type of asset on, your kids actually inherit that as if none of those gains had ever been there. Okay, so your family can take that and set a new basis for determining gains. So it's called a step up in basis. So they don't pay big taxes on death. So it's also a good way to transfer assets. And then finally, my favorite bucket, the tax-free bucket, where we find some very interesting tools. And we're going to dig deeper into how to draw out money and reduce your taxes during your retirement years, or anytime, really, frankly, for that matter. These strategies are great for business owners, entrepreneurs, or others who have flexibility because you've got money in more than one tax bucket. And if you'll visualize the first bucket being to the left, the taxable, like your ordinary income and short-term gains, you want to start moving money left to right. Get money into the tax deferred, get money from the tax deferred into long-term capital gains and tax-free. We want to, when we have the opportunity, to reduce the amount of future and present taxes. So slowly emptying those buckets out from our IRA, 401k, as well as our personal taxable income in our ordinary taxed accounts. And I'm going to show you how to do a little bit of that today. And then as we need more time, we'll take time in future episodes. So what am I really talking about? Well, I'm talking about tax planning. I'm talking about life planning for the biggest expense that you're going to have. Let's start, though, and talk about retirement, okay? Most people, unless they get ahead of this, are going to pay too much taxes on their retirement income. Colin, what do you mean by retirement income? Well, of course, I mean your Social Security. Colin, wait a minute. Scratch the record here. Am I actually being taxed on something that I considered a tax? Well, you contributed to the Social Security program, but yes, as your money comes out, you will pay potentially taxes on your Social Security benefit. So let's do a little exercise here. So in 2025, if you take income from Social Security, your maximum benefit, if you wait till full retirement age of 67, is $4,018. If you're married and you both max that out, that's $8,036 potential income a month as a couple if you both had a career. Or it could be less than that depending on how things shake out. By the way, if you waited another few years, 3 years, your max benefit today at 70 would be approximately $5,108. So there is sometimes some wisdom in waiting, but I always tell folks with Social Security, it's about taking it when you need it. Now, here's the tricky part, okay? So we know we can get these benefits. Let's say you're that lucky couple that both maxed out your Social Security contributions over the years. You're taking $8,036 a month in your Social Security check today for a total of $96,432 of income. Wow, who would have ever thought you could be making close to six figures from Social Security, right? And we will be within just a year or two. And so Social Security is a tremendous program. Don't let people talk you into thinking that it's not going to be there for you. But what you've got to understand is the rules keep changing and the targets keep moving. One of those targets has to do with how much money you can earn over and above that. And by earning, I also include ordinary income or income that you take out of your tax-deferred investments. So that starts to make things much more challenging. So in our next segment, I'm going to dive a little bit deeper, and we're going to talk about how do I make my Social Security income tax-free during retirement. Wouldn't that be amazing? As we move from left to right, starting to move our money from taxable to tax-free, how can I get Social Security into the tax-free bucket? Well, we're going to talk about that next, but in the meantime, really, I'd love for you to give us a call so we can talk to you about how to build a comprehensive plan. We do this at no cost for our clients. If you're our client, the planning comes along. You deserve that. And we call this first step that we take a retirement freedom review. How free are you going to be in the three key areas: freedom of wealth, freedom of time, freedom of health? And I'd love to talk to you more about that. My team and I would love to help you. It simply starts with a phone call.